Hello fellow intelligent investors, my name is René Salman and today I want to discuss why I prefer companies that are run by their founders and why other investors should be attracted to these founder-led businesses too. And what I will do in this video is I will share a couple of studies that have shown that stocks where the founder is still the CEO, or at least chairman or board member, tend to outperform other companies in which the founder is no longer deeply involved in the business's operations. And I will explain why that's the case. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Salman and I'll teach you how you can manage and invest your money with confidence, a long-term vision and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, so in previous videos, I've already talked about the importance of having an investment process in place, an investment framework when analyzing companies. And there are many variables an investor cannot control. You can hardly control the outcome of your investments. But what you can control and improve over time is your investment process. So if you don't spend a decent amount of time thinking about the fundamental pillars of your personal investment style, I think you are doomed to fail in the stock market. As John Phelan puts it, we are focused on process, as I believe you should focus on process, not outcome. Process is the key to proper risk management. So my investment framework consists of a couple of pillars, and the 5 most important ones can be summarized in the following sentence. I try to invest in low debt, high quality companies that are run by honest and talented management, are available at an attractive price, and whose business model I can understand. So basically the 5 pillars are understanding the business, business quality, capabilities of the management team, low corporate debt, and fair price. And in this video I would like to spend some time discussing the management pillar. And before I do that, if you enjoyed this type of content and want to support my channel, be sure to hit the like button and leave a comment. And if you are new here, please subscribe to the channel and hit the bell button, because this would massively help me to crack the YouTube algorithm and thereby grow the channel. Alright, assessing the qualities of management is a very challenging task in my opinion, because there are a lot of qualitative factors involved when judging management quality. Factors that you cannot measure as easily as corporate debt, for instance. And when I examine the main operators of a business, I look at many different things, and I would say this is probably the most time-consuming aspect of my business analysis. For instance, I will check what management's compensation is tied to, whether management has skin in the game, so whether the CEO and other officers have a significant financial stake in the company, how management communicates with shareholders and also its customers, their capital allocation track record, strategic positioning, and obviously many other aspects as well. And generally speaking, I prefer companies in which the founder is still deeply involved in the firm's daily business. In fact, there are many studies on this subject, and the amount of evidence is growing that publicly traded companies, where the founder still plays a significant role as CEO, chairman, or board member, perform significantly better than stocks of companies where there is just a hired CEO in place. For instance, Bain & Company found that an index of S&P 500 companies, in which the founder is still deeply involved, performed almost 4 times better than the rest of the index over a 25-year period from 1990 to 2014. I mean, just take a look at this graph. It's quite astonishing in my opinion. And this evidence seems quite compelling to me. Another study by asset manager Schroders found that founder CEO companies invest more aggressively than their peers in research and development, spend more heavily on capex, and they grow revenues at a faster clip. And similarly, a paper titled Founder CEOs and Innovation, Evidence from S&P 500 Firms by Jong-Soo Kim et al. Found that S&P 500 companies where the founder is still CEO are more innovative. They generate 31% more patents. They create patents that are more valuable, and they are more likely to make bold investments and take their firms in a new technological direction if needed. And finally, a 2010 University of Pennsylvania study showed that small cap company CEOs, who are the founders, consistently beat hired gun CEOs on a broad range of important investing metrics, such as return on investment. And maybe I should just list a couple of publicly traded stocks that are or were run by their founders and who then created tremendous shareholder value. Steve Jobs and Apple certainly come to mind, Zuckerberg and Facebook, and of course Warren Buffett and Berkshire Hathaway. Other examples would be Robert Parra at YubiKey or Samuel Walton at Walmart. And one could also mention companies like Oracle, L-Brands or IKEA, which is not a publicly traded company though. What's interesting is that when I was conducting some research for this video, I've read that 7% of globally listed public companies with market caps of over $500 million are still run by their founders. And this trend is even more pronounced if we look at newer publicly traded companies. If you consider globally listed IPOs over the last 5 years, for instance, 30% of these stocks are led by their founders. Now, clearly, these empirical findings beg the question, why do founder-led companies outperform or perform particularly well? Well, a number of theories have attempted to explain the founder-led company outperformance, but I think 3 factors are the most relevant here. So let me share these 3 explanations. Well, first and foremost, founders usually have a major financial stake in the company. Founder CEOs almost always own a large amount of equity in the business, and usually the financial stake in the company represents the vast majority of their net worth, thereby clearly aligning their interests directly with shareholders' long-term interests. Because with their own wealth at stake, founder CEOs obviously have this extra motivation to make the firm succeed in the long run. Now, clearly this alignment of interest stands in stark contrast to the incentives of a hired professional management team, especially if the salary of that management team is not tied to the performance of the business or is tied to the wrong metrics. For instance, a CEO whose compensation is primarily tied to a firm's revenue may be tempted to undertake acquisitions that boost revenue in the short term but hurt the firm's bottom line in the long run, as maybe the CEO overpaid for the acquisition, or if the acquisition doesn't support the long-term strategic goals of the firm and doesn't generate any significant synergies. On average, hired CEOs tend to own far less stock than founders do, and these CEOs can theoretically be fired at any time. In the US, for instance, the average tenure is only 8 years, and consequently these corporate leaders are incentivized to rather focus on, next year's bonus or their reputation, rather than the company's performance in 10, 20 or 30 years from now. And as we said, there's actually empirical research showing that founder CEOs, on average, invest more heavily in the future through research and development and patents than companies run by hired CEOs. A large ownership stake in the business means a founder's wealth is far more influenced by the longer-term valuation improvements than a salary, and thereby shifting a founder CEO's focus on the long-term improvement of the business. And Charlie Munger, again, Warren Buffett's long-time business partner, he famously said, "I think I've been in the top 5% of my age cohort all my life in understanding the power of incentives. In all my life, I've underestimated it." But founder-led companies do not only have a significant financial stake in their company, but also an emotional stake. And I think this is the second reason for the exceptional performance of owner-operated companies. The most profitable businesses tend to be those focused on delivering customers a great product or service, focused on delighting their customers, not the most profit-orientated businesses. Jeff Bezos is probably the best example for this. He has always stressed that he thinks obsessive customer focus is actually the best protection against competition. And for the founders of the business is their baby, it's their life's work. And they often care more about the firm's mission and the purpose than their own personal net worth. Just look at Warren Buffett. Berkshire pays him a salary of $100,000 a year, and he still lives in the same house he bought back in 1958 for around $31,000. And John Kay noted in his book obliquity. Many of the business people who talk obsessively about profit are ultimately less successful in creating profit than those who profess love for their business. As a result, owner-operators nurture and guide the business like their own child, and then they watch it grow and celebrate their success stories much more passionately than others who are not maybe as emotionally invested within the business. Owner-operators have made a lot of sacrifices for the firm. No one believed in the idea at first, and maybe they had to invest their private wealth in the early years. Maybe they even had to borrow capital from friends and family. And moreover, no one knows the company better than the founder of the firm. They have personal knowledge of every employee they hired, every product they made, and every customer won in the past. Ben Horowitz refers to this as a pyramid of knowledge that is impossible to replicate for others. If you've ever founded your own company, you probably understand how important the business can become to you. And so clearly these owner-operators care about their business. And as a result, they have this deep curiosity for what is going on in the company, but also the competitive landscape the firm is operating in. And they try everything to make sure the business can adapt to changes in the environment quickly. And just to stress my point here, let me share a quote from an investor I really look up to, John Huber. He said, "I've spent a lot of time thinking about factors that influence the long-term success of a business. And I think firms, public or private, that are run by the founders often have a huge intangible quality to them, one that is crucial to the firm's ultimate success. This intangible quality is that the founder is often motivated by much more than money, and that is a driving force that can be incredibly powerful and incredibly valuable for the owners of those firms." And then there is a third reason for the outperformance of founder-led businesses. And this is another intangible quality that is particularly hard to measure. Because founders tend to create a unique, healthy corporate culture that promotes flexibility, long-term thinking, innovation, commitment to customers, and employee loyalty. Clearly, the internal culture is set and modeled by the founder, because anything that you want to shape or influence within a small or a large organization has to start with the person at the top. As Anchor Capital puts it, company founders build up a storehouse of social capital by creating a company and providing jobs and a sense of purpose for their employees. As a result, they may have an easier time inspiring and leading the organization, which lead to better products, happier customers, and smarter decision-making throughout the company. A few examples of unique corporate culture that came to my mind were Amazon's culture that is obsessively focused on delighting its customers. Facebook is known for developing a culture of innovation, because Facebook seems to be driven by creativity, innovation, and an open culture which rewards creative problem solving and rapid decision making. And I think Nintendo is certainly another great example for an innovative and dynamic corporate culture that is hard to copy and therefore also providing a moat that will protect the business. Another and third example that came to my mind is Southwest Airlines. Generally speaking, I think it's fair to say that the airline industry is often mocked for its grumpy employees and bad customer service. But Southwest Airlines is different. If you ask a passenger that has flown with Southwest Airlines, they will often describe happy and friendly employees who try everything to satisfy their passengers. So, I think the bottom line here is quite simple actually. Empirical data shows that founder-run businesses, on average, tend to be more compelling investments. And as we have shown, there are many rational reasons for this, even though these factors are somewhat hard to measure. That's why I think as an investor who is looking for new stock ideas, the universe of owner-operated businesses that have a lot of skin in the game is a great starting place. And in fact, we have discussed that the universe of founder-led companies is actually quite large, as 7% of globally listed companies are still run by their founders. But that doesn't mean that you should just mindlessly buy all of the companies that are still run by their founders. I actually like the conclusion of the paper of Anchor Capital, because they wrote, "Although it is clear founders as a whole tend to outperform the broad market, one can do better picking the best of the founder-led companies. versus passively investing in the group as a whole. Thus, we believe it is important to take into consideration industry margins, competitive products and services, etc. Further, we feel it is important to 1. Look at the founder's long-term track record. 2. Look for a strong business model with clear long-term competitive advantages. And 3. Carefully assess the price of the business, as price always matters. And that should already be it for today. Please hit the subscribe button if you liked my video and hit the like button or leave a comment. May your finances and investments prosper. Good luck.